If you've been paying even the slightest bit of attention to the commodity charts recently, you know the global silver market is no longer a footnote. It is really the epicenter of volatility. What started as a promising rally back in 2024 has, in 2025, just exploded into what looks like a systemic structural crisis. And it's challenging every traditional valuation model we thought we understood.
It really is.
So today we are diving deep into the sources covering this unprecedented move in silver as of early January 2026. And the numbers are, well, they're frankly staggering.
They are?
Silver is currently trading at approximately $80.64 an ounce. That price reflects a breathtaking, 150 to 175% increase in nominal value just over the last 12 months.
And when you see a parabolic move like that, our listener has one core urgent question.
Right.
Are we watching a speculative bubble that's destined to pop and pop spectacularly? Or is this a fundamental repricing? Has silver genuinely shifted its paradigm from just being a monetary metal, a shiny hedge?
It's little brother status to gold.
It's exactly, to becoming an absolutely critical industrial resource.
That is the mission for this deep dive. We are unpacking the forces driving this structural supply deficits, the escalating geopolitics, and that paradigm shift in demand. We're talking green energy and the massive AI infrastructure boom. We want you to understand not just what happened, but why the future growth potential looks so different now.
But before we go any further, we absolutely have to make this explicitly clear.
Yes.
Our analysis is drawn entirely from the sources provided, and it is for informational purposes only. This is not financial advice. You must conduct your own thorough research and due diligence before making any investment decisions. We are analyzing the data, not dictating strategy.
With that necessary context set, let's unpack this phenomenal rise. Let's look at the recent past.
Okay, looking back at 2025, silver started the year near, $28.92 per ounce.
Right.
It then staged this explosive climb, and it culminated on December 29, 2025, when it hit a record nominal high of $85.87.
So in one calendar year, silver delivered a minimum 150% gain. That's incredible.
And that just blew past its traditional older sibling, gold. Gold had a very respectable year, but
Modest in comparison?
very modest.
Yeah.
It saw a gain of about 74 to, say, 76.5% during the same period. Silver was the clear outperformer.
And you can see that outperformance in one really key metric, right? The gold to silver ratio.
Yes. This ratio, for anyone who doesn't follow it, just tells us how many ounces of silver it takes to buy 1 ounce of gold. And earlier in 2025, that ratio was way up, exceeding 100 to 1.
Which means silver was fundamentally undervalued relative to gold, at least based on historic averages.
Exactly. But thanks to silver's rapid, explosive outperformance, that ratio just compressed dramatically. It almost halved. By the first week of January 2026, it had tightened into the mid-50s. I think the range was between 55.48 and 56.64.
A move from 100 to 1 to 55 to 1 in less than a year is astonishing. What does that compression fundamentally signal to a market analyst?
It signals the market is correcting a historical anomaly. I mean, when the ratio is 50 or 60 to 1, it implies silver is absorbing its fundamental value relative to gold. The massive tightening tells us the market is rapidly waking up to silver's new status as a strategic, supply-constrained industrial metal.
So the days of silver just being the cheap alternative to gold are over.
They appear to be. The relative scarcity is being recognized in real time.
And that brings us immediately to the foundation of the thesis, which is scarcity. The primary driver here isn't just enthusiasm, it's a deep-seated structural deficit.
Precisely. And we are not talking about a temporary dip in production. We are discussing a chronic shortage, a structural supply deficit that has now persisted for 5 consecutive years. And the shortage is deep. The cumulative deficit just between 2021 and 2025 is almost 820 million ounces.
Wait, 820 million ounces?
Yeah.
To put that in perspective, that's like an entire year of average global mine output simply gone from the market over 5 years. My question is, where did the market find those 820 million ounces if they weren't being mined? Where is that inventory coming from?
It came directly from existing surface stocks. Physical inventories held by exchanges like the COMEX, government stockpiles, investment trusts. Those inventories have been drained to service demand, and they are now critically low. If we just look at the raw data for 2025 alone, demand was estimated at 1.24 billion ounces versus a total supply of roughly 1.01 billion.
So that's a shortfall of over 200 million ounces in a single year. That single year shortfall is the equivalent of Mexico's entire annual output, and Mexico is the world's largest silver producer.
Correct. And this is where we hit the aha moment of the silver market.
Uh,
Supply inelasticity. The price is $80 an ounce, yet miners are not rushing to flood the market with new supply.
Why not? I mean, if the price is that high, shouldn't capital expenditures just surge?
You think so? But approximately 70 to 80% of global mined silver comes as a byproduct of mining other metals.
A byproduct.
Right. Primarily gold, but also lead, zinc, and copper. So a dedicated silver miner, when focused purely on silver, is actually quite rare. Most silver production is incidental.
So this is a structural problem that money literally cannot solve in the short term. You can't just go open a silver mine because silver is $80. You have to wait for the primary base metal, copper or zinc, for example, to justify that massive investment. Silver is just a fortunate but secondary consequence.
Exactly. The decision to increase supply is governed by copper prices, not silver prices. And this incidental nature of production ensures that even if silver hits $100 or $150 per ounce, mine supply remains largely flat for years. It cements the persistence of this structural deficit.
This supply inelasticity, it makes the demand side of the equation even more explosive. The narrative truly changes when you realize silver is shifting from a shiny asset hedge to a critical technical metal. Today, industrial applications account for, 50 to 60% of annual demand.
That's right. And this shift is driven by three huge technological pillars, all related to global decarbonization and digitalization. The fastest driver is the solar revolution. We're talking specifically about photovoltaic, or PV, demand. Silver's superior electrical conductivity is just irreplaceable in the silver paste used for cell contacts.
And the growth here is exponential.
Absolutely. In 2024, solar accounted for roughly 25% of global silver consumption. That's a massive leap from just 11% back in 2014. And the growth projection is just relentless.
Even with thrifting, the process of trying to use less silver per cell, the sheer volume of installations is overwhelming those savings.
It is. Solar manufacturers are projected to require over 20% of the entire current annual supply by 2027. That is an enormous guaranteed industrial pull on a market that already has a gaping deficit.
And beyond solar, we have the electrification of transport. A typical internal combustion engine vehicle uses, 15 to 28 grams of silver?
Right, but a battery electric vehicle, a BEV, requires between 25 and 50 grams per unit.
Wow.
That's a 67 to 79% increase. It's essential in the power electronics, battery management, fast charging. And analysts predict that BEVs will overtake combustion engines as the primary source of automotive silver demand by 2027.
And finally, the newest heavyweight demanding silver, the AI infrastructure boom, high-performance computing data centers.
Silver is crucial there for its low-resistance signal processing, for connectivity in complex circuit boards. The sources noted that total global IT power capacity has increased by something like 53 times since the year 2000. When you have an explosion in computing hardware, especially for generative AI, it translates directly into a massive growing demand for specialized circuits that rely on silver.
So we have the structural deficit, we have relentless industrial demand. Now we layer in the systemic shocks and macro factors that pushed us over the edge. Starting with China, what major shift did Beijing impose on January 1st, 2026?
China introduced a massive systemic shock. They effectively weaponized their supply dominance. They implemented strict new export restrictions on licensing requirements on refined silver.
And this matters because China controls, what's the number?
Between 60 and 70% of the world's refined silver supply.
So how do these restrictions actually work?
Under the new regime, only massive state-approved firms with a production capacity of at least 80 tons can export silver. Now, this sounds technical, but the practical effect is this. It completely blocks hundreds of smaller, independent global refiners and exporters who previously serviced the Western market.
So that doesn't just reduce supply. It forces global buyers to compete fiercely for the supply that is now bottlenecked and controlled by the state. This is a strategic move to secure domestic industrial advantage for their own solar, EV, and AI sectors.
Precisely. It accelerates the physical inventory drain in Western exchanges and introduces a massive artificial supply friction into the global market.
And on top of that, we have to consider the geopolitical safe haven demand that provided a strong support base in late 2025 and early 2026.
Absolutely. The geopolitical temperature has been soaring. We saw the systemic shocks related to the U.S. naval blockade and capture of the Venezuelan leader Maduro, alongside persistent tensions in the Middle East and Asia. These risks inject a crucial risk premium into safe haven metals, reinforcing silver's monetary role alongside its industrial one.
And on the macro front, U.S. monetary policy has certainly provided a tailwind.
It has. The Fed implemented rate cuts throughout 2025, lowering the federal funds rate to a range of 3.5 to 3.75%. But inflation proved sticky, staying around 3%,
So real yields declined.
significantly.
Yeah.
And that reduces the opportunity cost of holding non-yielding assets like silver, making it fundamentally more attractive compared to bonds.
In that context, combined with the wider trend of de-dollarization, with central banks like Poland, India, and China actively buying physical gold and silver, it provides powerful structural support for the whole complex.
They're strategically responding to the perceived politicization of the dollar.
Given all those massive tailwinds, we have to face the question, is this price sustainable? Let's address the valuation first. Is $80 expensive? Nominally, yes, it's a record, but what about when we adjust for inflation?
When you adjust for inflation, $80 is actually still relatively cheap. To reach its inflation-adjusted high, silver would need a massive move. The infamous 1980 peak of $50.21 is equivalent to approximately $170 to $200 in today's purchasing power.
So we're not even close to the real value historical maximum.
Not even halfway there.
That perspective is critical. If this structural shift truly warrants a repricing, what does the extreme end of the valuation model suggest, using that gold to silver ratio?
Well, if the physical squeeze continues and the market decides silver's industrial importance warrants a ratio closer to historic lows, say 20 to 1, and if gold stabilizes around 4,500.
Then silver could theoretically be valued at $225 an ounce.
It's a staggering number, but it highlights the extreme potential that analysts are starting to factor in if this supply crunch is permanent.
Which forces us to ask, what would a $225 silver price do to the solar industry overnight?
Exactly, and we will get to that demand destruction risk. But first, let's address the elephant in the room, the immediate technical headwind. What is the biggest risk to the price in the next few weeks?
We're talking about the massive annual rebalancing of the Bloomberg Commodity Index, which started on January 8th.
Correct. Due to silver's spectacular performance, its weighting in the index must be drastically cut from 9% to under 4% to comply with index rules. This is not a voluntary decision. It's a mandated forced sale.
And this requires index tracking funds to liquidate, what, over $5 billion in positions?
That's the estimate. This massive forced selling translates to the equivalent of 13% of the total open interest in the COMEX silver futures market being unwound over a short 2-week period.
And the analysts expect this to cause significant downward repricing.
In the short term, yes. It's important to stress this is a technical move, not a fundamental rejection of silver's long-term story.
So investors need to brace for volatility. What are the key technical levels to watch during this forced liquidation?
Technical analysis suggests immediate resistance sits around $82.50 to $84. But due to the pressure, the critical bullish support level, which must hold, is $64.45.
And the upside target, once this clears?
$101 per ounce.
This brings us back to your earlier question about demand destruction. Let's look at the biggest long-term counterargument, the copper substitution threat in solar. If silver accounts for, say, 15% of a solar module's cost, manufacturers must be desperately exploring alternatives. Copper is 100 times cheaper and 1,000 times more abundant.
It sounds like an existential threat, and it is a risk. But the change is not immediate. Substitution is not a simple drop-in fix.
Why not?
The cost of conversion is immense. Converting a single solar cell factory to copper takes an estimated 18 months of retooling, and there are hundreds of factories. Furthermore, certain high-efficiency technologies, like advanced 2-pecon cells, are particularly resistant to substitution due to the high-temperature fabrication processes, which copper can't easily withstand.
So demand destruction, while inevitable at high prices, is expected to be gradual.
Exactly. It's a friction point, not an overnight catastrophe.
Looking at the 2026 to 2030 projections from the sources, what's the balanced consensus?
For 2026, the consensus expects a healthy consolidation, following the index selling we just discussed. Institutional targets are wide, from a bearish $58 from JP Morgan to a more balanced 70 to 80 from Citigroup.
And the retail consensus.
They're holding fast to targets of $100 to $200.
And long term, assuming the deficit persists.
The sources suggest a potent growth trajectory. Forecasts suggest silver could climb to $133 to $143 by 2027 and potentially exceed $200 by 2030 if industrial demand accelerates even faster than anticipated.
So what's the final strategic prognosis we can draw from this deep dive?
The immediate prognosis suggests you should expect a challenging first quarter in 2026. That rebalancing will likely test the $65 to $70 support zone. However, the widening structural deficit fueled by inelastic supply and explosive industrial use keeps the path toward $100 an ounce, a realistic target for late 2026 or 2027. The long-term structural floor for silver has moved significantly higher.
The core message is clear. Silver must be viewed through its newly reinforced dual role. It is a monetary hedge against global instability and an indispensable industrial component for the technological future AI, EV, and solar. The era of consistently cheap silver fueled by easy supply appears to be fundamentally and structurally over.
And that leads to the final provocative thought for you to consider. Despite the short-term volatility from margin hikes and index rebalancing, what happens to the price if China successfully weaponizes its export controls over the next 2 years? I mean, if they maintain that physical supply bottleneck, that geopolitical control, combined with relentless green energy demand, could redefine the meaning of silver scarcity globally, making the deficit truly permanent.
A truly fascinating and critical deep dive into a market that has clearly broken from its historical mold. Thank you for joining us today for this exploration of the silver squeeze. If you found this discussion valuable, please hit that subscribe button and ring the notification bell icon to support our channel. It ensures you don't miss our next deep dive.